This is a very important aspect of investing because in an era of very high quality and fast information that we live in, investors, retail investors and high net worth investors often have access to the investment strategies and portfolio picks of very high profile investors. So the moment they hear person X or investor X has accumulated a certain stock, they rush in and copy that pick and buy that stock. However, after 1 or 2 years, it turns out that having followed such a strategy with various investors, portfolio returns are not commensurate with that of some of the smarter investors. There are many reasons for that, but among them, one of the most important reasons is that retail or HNI investors might copy the portfolio selection or the stock selection, but they do not take adequate care to monitor how the weightage of that particular stock is moving over a 1 or 2 or 3 year period in the portfolio of the smart investor. Because if you look at the portfolios of smart investors, it is often quite visible that in a portfolio of 20 stocks, the real returns are actually generated by no more than 3 or 4 stocks. So after 3 years, the 20 stock portfolio might have returned 30%, but that 30% return is because 3 stocks have doubled or trebled in that period. The returns from the remaining 15-16 stocks have been at best average, some are actually bad. So how do smart investors make such a lot of money? They actually realize during the course or early course of their investment what is working and what is not working. And the moment they spot a stock which is working better than the others, they start accumulating more of that name. So the 3 stocks which are the outperformers in the portfolio actually end up after a period of 2 or 3 years having a disproportionately large weightage in the portfolio. However, the small investor does not do that. He keeps buying the stock, but at the end of the 3 years, all the 20 stocks have more or less the same weightage in that portfolio. And therefore, the 3 outperformers and the 3 underperformers cancel each other out and portfolio returns are not great. So the thing that you must remember, if you're copying the investment picks of large investors, is what they're doing with weightage, and weightage. Because the weightage of the outperforming stock in the portfolio has a great bearing on what your eventual portfolio returns turn out to be. This is the other aspect which differentiates smart investors from retail investors, which is the aspect of entry and exit timing. The first issue is, when are you entering the stock which a smart investor has bought? Smart investors, by definition, have access to higher quality information because it is their game. This is what they do full time, and they're large investors. So it may seem that on paper, the information flow is all democratic between classes of investors, but it's often true that the smart investor actually gets a whiff of a turn in the fortunes of a company, either from the management or from sources close to the company, well ahead of the retail investor, which puts them at an advantage. Also, disclosures about portfolio selections or portfolio entries comes in with a lag. So you hear that your favorite investor X picked up a stake in this company at the end of the month when the stock was accumulated 2 weeks earlier. In that 2 weeks, and even more importantly, in the weeks while he was accumulating the stock might have actually run up quite significantly. So you are coming in late to the party. That is the first thing. The other is, when are you exiting? Sometimes you figure out much later, after the smart investor has exited, that portfolio stock is no longer there in his portfolio, and then you rush to exit that stock. But by then, the stock has tanked quite a bit. And in this day and age, if there is some kind of an adverse development, stocks move very fast. Take the example of a mid-cap company like Manpasand Beverages and how quickly it lost half of its market cap. So if you were waiting, or if you were traveling on work and you suddenly came back after 3 days, you would have found that the stock in your portfolio had tanked has lost half its market cap, and that would have been such a big erosion of your wealth. So the timing of the entry and the exit matters a huge deal in your portfolio returns, and in that, smart investors are many steps ahead of the retail and HNI investor, which you must factor in while investing or copying others' picks. This is a very, very crucial aspect, because it is not just enough to keep buying stocks which smart investors own. What are you doing with these stocks? And one finds that at the end of such kind of copying, because you're copying investor A, then investor B, and then investor C, who may all be very successful investors, and at the end of 2 years, you find that you've got 60 stocks in your portfolio. That is not a very smart portfolio strategy. If you look at smart portfolios, what they're doing is that they're constantly monitoring the stock in their portfolio, and even more importantly, they're weeding out, exiting the stocks which are not performing. So after 6 months, if a stock is down, or 1 year if the stock is down, and they believe that they have made a mistake, they're quick to admit that and throw the stock out of their portfolio. Now, this aspect of spotting a loser, identifying a mistake, or conceding a mistake to yourself and moving a stock out of your portfolio when it's losing money for you, is something which a retail investor finds very, very difficult to do. And this makes a big difference in the eventual portfolio outcome, because you keep on accumulating, but you do not keep throwing out underperformers. And you may at the end of the process have some really outperforming stocks, but your underperformers tend to weigh down the overall portfolio returns very significantly. So do not spot only what your smart investor is buying. Also keep a track of what he's selling periodically, or what they're selling, because in that might lie the answer to why your return is not commensurate with the return of the smart investor, because he buys and he sells and you only buy, and then you end up with a crowded portfolio and the returns are not great. There are two ways to approach it. It is not a wrong thing. One might get the impression, listening to all that has been said, that you should never copy what a smart investor is doing. That is not quite true. But you have to distinguish between large caps and mid caps. In large caps, the information flow between smart investors and small investors is actually practically not there. In names of Infosys, HUL, ICICI Bank, everybody more or less knows the same thing. Therefore, you don't have an information advantage. And therefore, if you start by saying, I will copy what the smart mutual fund manager is doing in a large cap fund and beat him, that's going to be difficult, because the timing issue will get in the way. And the timing of entry and exit, if you factor in the cost of that between you and the smart mutual fund manager, and you compare that with the cost of owning the mutual fund, which is the fee that you're paying to that fund manager, more often than not, you'll find that the cost of entry and exit by doing it yourself directly is actually higher than the fee that you're going to pay for the mutual fund. So I would recommend or suggest that if it's large caps that you're interested in, then don't try to be cute and follow the individual fund manager and do it yourself. You pay that 1%, 1.5% mutual fund fee and give it to the mutual fund to manage. For mid caps, it may be different, because mid caps, for all the reasons, there might be information asymmetry. You might suddenly be alerted to an interesting stock which no mutual fund owns because a smart professional investor has bought it. So do track by all means what smart investors are buying, but don't follow them blindly. Do some research about whether you want to be invested or exposed to such a business to begin with. And if the answer to that is yes, then you must make it a point to track it more carefully and follow the exit and entry patterns of these smart investors. So in short, for the large cap, go with the mutual fund. For the mid cap, follow the smart manager, but then follow him a little bit more closely than you ordinarily would.